Hi everyone and welcome to this week's IMAX FinTech Weekly Market Insight. As usual, it's split into 4 parts. The first one is we look back at what happened last week. The second is looking forward to what's going to happen this coming week. The third part is my macro outlook, and the fourth is a lot of analysis that I put together on a variety of asset classes. So I hope you enjoy it and I hope you watch all of it. As usual, we start with our disclaimer. So trading does involve the potential risk of loss of capital and is not suitable for everyone. As I say every week, hopefully it is for you. And of course, many companies provide leverage, so just be aware you can lose substantially more than that initial investment. Now, any views, opinions, everything that we include in here is just for educational purposes. We're not trying to convince you to trade or invest. It has to be your decision. And before you make that decision, of course, consider the risks involved, your financial situation, definitely your level of experience and risk appetite. And of course, only risk capital you're prepared, or more importantly, you can afford to lose. If not, then consider one of the trading challenges to get a funded account. And if you've got any doubts whatsoever, seek independent financial advice before risking your capital. So there's plenty to talk about from last week. There was lots of central bankers all sort of just speaking and airing their views on the economy and interest rates and inflation, of course. They were mainly hawkish, especially from the key ones. Powell expects 2 more. And for them to possibly be back to back. Lagarde from ECB and Bailey from the Bank of England also expect further rate hikes. Inflation levels are just becoming stickier. It was a little bit of a surprise, I guess, that Spain's inflation dropped while Germany's sort of went up again. Now, when we look at the actual data from last week, so the Dallas Fed manufacturing was higher than expected, although it was still negative 23.2. Durable goods was higher than expected at 1.7%. And again, that just shows consumers in the US are still happy to spend, because looking at durable goods, these are generally the bigger ticket items. These are goods that last 3 years or more, or supposedly, and of course they're the more expensive, sort of more fixed things. Housing data was also better than expected. I think now that Americans have just accepted that rates will remain higher for a while, that was reflected in new home sales that increased by a real surprising 12.2%. The GDP annualized was 2%, and jobless claims were actually lower than expected, with initial jobless claims coming in at just 239,000. Again, this just demonstrates the strength of the US economy at the moment, and that's despite all these rate hikes. Major banks passed their stress tests. I've got to say, I wonder if the Fed could pass one, considering all the treasuries that they're holding on to that must be absolutely hemorrhaging billions. Yellen continues to auction treasuries. She's trying to play catch up. Now the debt ceiling sort of fiasco's over. And of course, she's sort of racing to raise anywhere between, I guess, $0.5 to $1 trillion before liquidity dries up over the summer period. In fact, 3-month bills trading around about 5.18%. So PCE was lower than expected, but only just, and with core 0.3% month on month and 4.6% year on year. That did have an impact and reversed last week's dollar gains. In the EU, consumer confidence remains low. It's negative 16.1. Economic sentiment was lower at 95.3. as was industrial confidence that came in at negative 7.2. Although, again, as usual, services were better. They was at 5.7. And the CPI, their harmonized CPI, that is 0.3% month on month, 5.4% year on year. And the core was 0.3% as well month on month, which gives them 5.5% year on year. So, it's still all just sort of remaining around those levels. Now, German IFO, that's sort of like their business climate, came in lower at 88.5. And expectations of what's going to happen in the future from the business community was also lower at 83.6. And the German unemployment rate did increase to 3.7%. Again, all of this is just building that picture of what's going on in some of these countries. Consumer confidence dropped again to 25.4. And in Germany, CPI was higher at 6.4 and 6.8 year on year. Retail sales lower, down 3.6% year on year. So, again, when we're looking at Europe, I just don't think it's in a stronger place as when we look at the US economy. So moving on to the UK, GDP was 0.1% quarter on quarter, 0.2% year on year, and the shop price index 8.4%, so still way too high. China PMI manufacturing was 49. Non-manufacturing 53.2, which was higher than expected. And in Japan, retail sales were higher at 1.3% month on month. Although CPI did sort of have a little bit of a drop, the headline was 3.1% and the core 3.8%. And Canada, their core CPI came in at 3.7% year on year, which was a 0.2% increase month on month. Their GDP was flat month on month. Australia, so their CPI was lower than expected at 5.6% year on year, and retail sales were higher at 0.7% month on month. So also last week, oil wise, the US had a large drawdown of 9.6 million barrels. Again, that just shows demand in the economy, and that demand is still there. And of course, for me, I just believe that they have a much more solid economy than most, and that definitely includes Europe. And of course, there's a lot going on in Europe, especially when you look at France. They're experiencing riots. They've had them for pensions, they've had them for all different things, but more recently it's sadly because of a teenager being shot by a policeman. And that is likely to have a negative impact, especially over the summer, with lots of tourists being warned not to travel to France. Just a reminder of our services. So we do provide daily newsletters, global news, headlines, my views, and then there is also the option for daily chart levels and pivot points. We offer one-day workshops, 1-week courses, and of course our accredited masterclass. It depends where you are in your trading journey to what would be right for you. The best thing to do is send me an email or give me a call, and we can discuss it. And if you're already trading, we can help you get to the next level. If you're just thinking about getting into trading, we will help you and guide you and put you on the right path in your trading journey. Of course, around this as well, a couple of the courses that we do, which is our one of our 1-week courses and our Flexi Masterclass, they both also now include free attempts at the trading challenge to get that funded account that everyone dreams of getting. So again, reach out if you'd like more details. Trader mentoring, you know, I can just help you sort of identify maybe where you can improve, and then get you to that next level time and again. We consult to companies, hedging FX and commodity exposure. We provide trader education content to individuals, exchanges and brokers. And as I just mentioned, you know, why not look at these funded trading accounts, because they save you having to risk your capital, you know, whether you've got it or not. If you need any sort of further information, then it's info@cymaxfintech.com, and my email is chris.tubby@cymax-int.com. Okay, so we're going to move on to part 2, where we look forward to next week's events. Hope you'll stay with us for that.